Warren Buffett once said, number one rule is to never lose money. The number two rule is to never forget the number one rule. So in this video, I'm going to be going over 10 rules that you need to know before investing into a company, what you need to know that could potentially really impact your investing and your trading skills as a stock market investor. Before I get started, I would really appreciate you subscribing and hitting that like button below. So the first rule when you are looking into a company is to understand the company. Research it. What do you need to know about this company? And that could be questions like, what are their products? What are their services? What are they doing? Trying to fulfill in the market? What sector are they in? Are there a lot of good reviews, negative reviews, bad reviews? Is there positive sentiment where a lot of people love the company or people out there really don't like the company? If that's what the case is, I would not really suggest investing into the company unless you know a transition in the business model or the fundamentals of the company have changed. So really understanding what the background is of the company is very important to know. That is why it is rule number one, in my opinion, of the rules that you need to know before investing into a company. Rule number two is risk reward, and I will be going into more detailed rules later in the video. I'll have timestamps in the description if you want to skip forward, and while you're down there, you should subscribe. I would really appreciate that. But risk reward scenario, this is a huge and really important thing that you need to know, because if you're investing into a penny stock or a very, very small company, there's going to be much higher risk than investing into a big blue chip company, let's say Apple or Amazon. If you're investing into one of those two, you're not going to have as much of a risk as a small company that could fail or go bankrupt or just not have a fundamental company that is proven through business. They're still the early stages of their company, unlike Apple or Amazon, for example. And the whole entire risk reward scenario is the same and can be seen with almost every sort of investment. Real estate, going into bonds, putting your money into a savings account. A savings account, you are having no risk at all, but you only get like a 0.05% return. It's literally nothing. So understand the risk, because you are having low risk putting it into a savings account, but then again, you're also having more risk because you're actually losing your money compared to inflation. The price of everything out there is going up. S&P is going up on average, but your return in a savings account isn't going up. So understanding what the risks are and having a diverse portfolio. And also, you do not want to be putting all of your investments, all of your money that you have into one specific stock. Don't put all your eggs in one basket. That is a key term, a very famous term, and the reason is very simple. If you put it into a penny stock or even a big stock, let's say Apple, all of it into one company and it fails, you lose all of your investment, all of your money that you saved up to invest. That is terrible. You don't want to do that. So be aware of that and be cautious about that when you go to put your money into this certain investment. Rule number three is to expect the unexpected. This is a huge term, and I love this phrase because if you do not expect the unexpected, okay, now if you have an investment into a growth stock or any stock, you want to expect it to go up. That is fine. You can expect it to go up, and that is a good thing to have, is positive, optimistic feelings towards the investment that you're doing. You should when you are investing. But if the market has a correction or the market collapse or the entire economy collapses and crashes, don't get fearful. When you get fearful, that is when you decide to sell. That is when bad things happen. You sell for a loss, or you lose out on potential returns that if you were to hold it for 5 or 10 years, you would be able to get a much higher return than you would have if you sold. So if you are to hold everything and not worry and just understand what could happen if you are to see a market crash or if things are to go down, expect the unexpected, because if you do, you will not sell. You will hold it, and I will talk about another term in a second that is very important about this, but you will hold this thing long and you will be amazed by the return you could get in 5 or 10 years, depending on how long of an investment you want to do with this specific stock. Now this leads to rule number four, and that is to buy when there is fear. If you are doing this, that is because other people sold off because there was fear in the market. Everybody is selling because they're scared of something coming, more than likely because of the economy. But if a stock is to go down and it's still proven to be fundamentally strong, the business model is still there, nothing very harmful to the actual company, there should be no reason to sell, and you should want to buy. When you buy when there's fear, you are going to see and be amazed at the type of returns that you will see. In that instant, you will be scared, and I've had moments like that where I was like, I don't really think I want to invest. I'm kind of nervous to. But at the end, when I did, and I actually did just a couple weeks ago on Lucid Motors when it went down to like $15 or $16 a share, and it went down a lot at one instant, and I bought in, and then since then it's up like 50%. So it's just the fact of buying when there is fear. And if there is a huge sell-off and you love the company and you are 100% loyal to it and you love it, continue to buy it if it goes down. Dollar cost average down your investments. It will prove over the long term to be very beneficial. But I'm not a financial advisor. Now, rule number 5 is diamond hands. And this might come off as just a slogan or a funny thing to you, but this is a serious quote or phrase that you need to know because, like the last 2 rules, expect the unexpected. Remember to buy when there's fear. If you have diamond hands and a stock has fear, a stock has a sell-off, and you hold through it because it's a strong company, you will have not a financial advisor, but you will get and more than likely see a higher return of investment over the long run. 5 to 10 years plus, stocks perform very well. If you invested in the S&P 500, you've already heard all the ifs of if you did this, if I didn't sell this, if I didn't sell that, you would have a much higher return. Have diamond hands when investing into a solid company that you love. Do not sell off like the others that are fearful and go to sell it and create that sell-off of the stock dropping and crashing or the entire market. Do not do that. Diamond hands, hold forever, and you will be completely fine in the long term because a huge percentage of stocks that you hold long will actually give you a return. Now, not a financial advisor, and do not quote me on that, but I have seen a lot of proven statistics that the long-term investing, and if you have not heard it by now, is the best way to actually invest your money, not gamble, not bet, not do options, but actually see a return of investment. Now, this next rule, remember that when you invest into a company, you are practically a partial owner of the company. Apple, Amazon, I own them. But what you are doing when you are investing is you are pretty much owning the company, and what you need to have in the mindset is that you are an owner of this company. You want to see this company succeed. You want to see everything within the business model be very well. You want to look at things, and I'm going to talk about it more later in the video, but you want to look at financials. You want to look at net income, revenue, profit, gross profit margins. You want to have the mindset that all of the good things in this company, products, services, financials, everything is going to do very well. You want good reviews. You want a whole entire combination of everything, and you want to pretend that you're the owner, and you want to see everything out there be very positive and grow. You want to see very positive trends. Okay, so number 7, this rule, you are going to have to understand the addressable market for this company that you're looking into. You have to understand the future. Where are they headed? What is the potential market that they can fulfill? Now, if they are a company that's, let's say, gasoline vehicles, and let's just say it's a company that is not going to be an electric vehicle company ever, good luck to that company. Electric vehicles are the future and are going to be taking over everything. I doubt that any gasoline company in the future will give you a high return of investment. So from there, you want to look at not gasoline companies, maybe some that are transitioning into EV companies because they're already big and have money, such as GM, that's going to be all electric very soon. But companies that are fully EV, that are literally trying to dominate the entire market, are very speculated right now and very high hyped. But that's because of a reason, because the future is what determines a stock. If the company does very well in 2 years, it is going to give you a higher return of investment because there is growth in that specific stock, that company, that sector. If we are investing into EVs right now, everybody is, because the future of these companies potentially has a huge market. Cannabis could be the exact same way. It's been very speculated when legalization opportunities have been in the eyes of many people. But just something to be aware of, because that is a huge determinant when investing into a company. Because also, an investor, when you are investing into stocks, your investments are forecasted in. So if we're looking at Apple stock, their iOS, their new phone that's going to be out in a year, is probably already factored into this share's price. If they were to eventually just say, oh, all of a sudden we're going to do an EV. If Apple was to say all of a sudden they're going to do an EV and this is the EV that they're doing and this is how much, all the statistics, I guarantee Apple is going to shoot up in price. Not because they sold any EVs, but because they came out with the news and investors put their money into it based off of future expectations. The price will go up based off of that. That is something you need to be aware of, and a very important rule to know. Now, before we continue this video, I would really appreciate you subscribing, hitting that like button, and letting me know your thoughts about all these rules and what you think in the comments below. But that leads to rule number 8, and that is the business model. This is a huge factor because when you are investing, the company, the entire foundation of our share price is reflected based off of the market cap of the company and how the company also performs. the business is what drives a stock's price, because that is where it all comes from. The fundamentals are related to financials and the business behind it, not based off of, oh, chart analysis, this is going to make the stock go up. Yeah, it could short term and it could for technical analysis, but long term and for an actual company, it needs to have business operations and it needs to see growth. We want to see positive trends, and that leads me into the next rule, and that is to understand the financials. Net income, profit margins, gross profit, revenue, assets. We want to learn everything. EBITDA. We want to learn everything. All the ratios, even PE, PS ratios, everything about that, and we want to see positive growth. We want to see high demand from investors. We want to see high growth in all these financials, because if we see trends of positive growth, that means that the company is showing and starting to prove themselves that if we went from $10 billion in sales to 15 billion to 20 billion to now 3 or 4 years later at 25, 30 billion of revenue in this year alone, that is, first off, a few years of history that you want to see. That's a safe transition of history's growing. You don't want to go based off of the past 3 months. That's not enough time for a company to actually be analyzed fundamentally. But if you're looking at those couple of years and you see it actually going up like that, their statistics, their financials, that is huge for a company. That means that they're going to be receiving more than likely more profit to reinvest back into the company and make even better. An important example like this is Tesla. And I mean, for a long time, they've been going without profit. They had to raise capital, sell shares. They had to figure out their own ways to really get through the entire company's structure without a true business model that was providing enough capital to allow them to keep the circle rolling, the cycle of the business. So now that they are profitable, it has literally sparked the stock to go up like insane, because they are now able to, at least from the company's perspective, reinvest that money to build more factories, to do a lot more within the company. And along with the reason the stock's up is so much is because how much people love the idea. That is a very high demand stock, a very high demand sector, but the company is very true now with its business. It is starting to deliver vehicles. It's starting to prove that it is profitable. It's taking in money. It can put its money into investments. It can put it back into the company to make it better. And that is what you need. You want a company that can create its own money to put it back into the company to make it bigger and bigger. Not even on stocks, but on the company is going to see a continuous growth in our stock's return, our ROI. Now, the last rule, and I would really appreciate you subscribing because that is loyalty right there to stay to the end, but that is to understand the employees and who is actually in the background of the company. CEO, who are the officers that are controlling the company? Who is actually a part? Who is the team? Do they have a lot of years of experience? Do they understand what it takes? Do they have years of experience, but in the field that they are right now in? If this is a new field and it's all new to them, they're probably inexperienced. They're probably potentially going to make mistakes. Seeing experience in CEOs and very high up employees that are controlling the company is very important, and our investment relies on the actual workers of the company. This company A is just not going to go from company A being 5 billion to 50 billion without humans, without people actually making it better. Understand the employees. That is a very important thing that I think is underrated. Look into the CEO, understand what he's doing, how loyal is he with his companies, where is he from, answer all those questions I just discussed, because that is a very important factor to know. Now, all these you do and should know before investing in a company. Now, how exact you need to know, how in depth, that is determined based off of what you want to do with your due diligence and research. So, thank you guys for watching this video. I would really appreciate you subscribing, hitting that like button. Please let me know your thoughts about this and any rules that you think you might not like or do like a lot more than others. I would really appreciate your feedback. Thank you.